A lot of this silver moved to New York. There was still demand for silver out of London, and that caused a squeeze. And we saw the silver price move up with official CPI inflation, the peak in 1980 at $50, would be more like $200 today. Silver starts to outperform, that ratio starts to come down. And even if it may have averaged, let's say over the last 20 years, 68, 69, I would think it tends to overshoot when it corrects. So I would think, we could easily expect it to go to 55, 50-ish. If it goes to 55 and we have gold around 4,000, we're looking at almost $70 silver. So how long will that take to play out? I don't know. Could take a year, could take a couple of years. We're now, I believe, at the midpoint of the Fed rate cutting cycle because they paused and now they've resumed. In any case, if you use the bottom from last February and you project upwards, that would take us to $95 silver.
Silver's story is quietly becoming one of the most compelling setups in the entire commodities market. As gold stabilizes near record levels, silver is emerging as the metal with the most asymmetric upside. The fundamentals are aligning, physical demand remains strong, global inventories are tightening, and inflation expectations are becoming embedded in the public psyche. With consumers increasingly skeptical of official inflation figures and believing real price growth is closer to 5%, few are willing to part with their physical silver. This environment, coupled with ongoing Fed rate cuts, is setting the stage for a decisive move higher. Peterkrauth, a leading precious metals analyst, highlights how silver historically lags gold early in a cycle but ultimately outperforms once momentum shifts. With gold consolidating near $4,000 and the gold-to-silver ratio poised to compress, a $70 to $90 silver price within the next couple of years is not unrealistic. As past cycles have shown, silver's explosive rallies often unfold midway through rate-cutting phases, right where we stand today. All signs point toward an unfolding revaluation in tangible assets. Those positioned early could benefit the most. Now, we present the clips from Peter Krauth's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
When there's this, surge in demand, there's always these secondary private hoards of silver that at higher prices will come to market. And I just think that we're not in the environment where, a little bump in the silver price is going to make people bring that back to bullion dealers and help with supply. I think we are in a different kind of environment. People are sensing it. In my recent presentations, I talk about inflation expectations. Right now, according to University of Michigan, looks at consumer surveys, they see consumers expecting a year out from now that inflation is going to be 4.8%. That's what they feel that they're living. And, we're being told official inflation is 3%. If you own some silver, are you going to be willing to part with it when you think inflation is more like 5%? If you look historically at how silver prices have behaved and you just on official inflation numbers, if you adjust for US CPI inflation, the peak in 2011, so not all that long ago, of $50 temporarily, would have to be more like $72 or $73, I think, right now, if not higher. Again, with official CPI inflation, the peak in 1980 at $50 would be more like $200 today. So I think people see this, they feel what prices are like. I think higher inflation expectations are now embedded. They don't think that we're going back to 2%. I think, frankly, 4% eventually is going to be the new 2%. And I think people see that and feel that. And that's why we are really in a different kind of paradigm and environment for silver, but precious metals and metals in general, almost all kinds of hard assets. It was from looking at a longer term chart of gold going back to say 2000 or so when it bottomed. And what struck me just looking at the chart is that you had these rises and then a sideways movement and then a rise and then a sideways movement. Each time you had that, it looked like a step in a staircase. And so that's why I said, we're living a golden staircase. And with more volatility, I think we're going to start to see something similar in silver. I think we're going to see these rises. Maybe it won't be a flat step. It'll be a drop, but if you kind of average it out before it starts to move higher again, you have these peaks, retreats, and then eventually sideways movement and then a new run up. And, I just think that, if you look at, so we talked about industrial demand, the investment demand that ebbs and flows. Honestly, we're we're in an environment now where you look at things like the gold silver ratio, you look at other assets like the Dow, the S&P. If you look at a ratio of silver to the S&P, we peaked in 2011. These things take often, if you look at general stocks like the S&P versus silver, you see very, very clear. It's very useful, I think, to look at these charts because you see very clear overvaluation of silver and then undervaluation of silver. And we're clearly in a period of undervaluation of silver versus general stocks. That chart has done this in 2011 and then is doing this right now. And this could take about, as I say, maybe a couple of years to play out, but we're clearly starting to trend back up. And what is, assuming it continues to play out as it has, and we have this new cycle continue, and that ratio starts to trend up again, you can have silver move up, you can have stocks move down, you can have different kinds of combinations of these things, but I think that's the most likely one. Silver were to continue to move up, stocks are likely to peak, and that to me is one big one that points to higher silver to come. You've got the gold silver ratio. What I find interesting is that, these are moments in time. When you look at the ratio, you're looking at a gold price, you're looking at a silver price, and you're saying, okay, it takes this many silver ounces to buy 1 gold ounce. Well, on the mining side, what I find interesting, Eric Sprott has some great way of looking at it. And of course, he takes considerably leveraged bets when it comes to his mining plays. But he says he believes one of his big advantages, and I'm sidetracking a little bit, but it just came to mind. He says he believes one of his big advantages versus other investors is that compared to, let's say, analysts or mining executives, he doesn't use, these considerably below spot silver prices when he's evaluating a project and the potential for a company. He uses current spot prices because he truly believes that, with some variation, some potential for volatility, it's indicative of where we should be and probably conservative in terms of where we're going. And so if to relate that back to the gold silver ratio, you can look at the ratio at a moment in time. Right now, gold is around 4,000, silver is around 48. And if when we're in this kind of environment where silver is doing very well and catching up to gold, and I'm assuming that I do expect that to continue, the ratio typically compresses. In other words, it goes down. It takes less silver ounces to buy 1 gold ounce. So you can make your assumptions and your calculations in different ways. And one of the first ones would be to pick a gold price. So let's say we assume gold is going to stay at $4,000 or continue to average around $4,000. And if you assume, again, historically, that's what we've seen happen in bull markets for precious metals, silver starts to outperform, the ratio starts to come down. And even if it may have averaged, let's say over the last 20 years, 68, 69, I would think it tends to overshoot when it corrects. So I would think, we could easily expect it to go to 55, 50-ish. If it goes to 55 and we have gold around 4,000, we're looking at almost $70 silver. So how long will that take to play out? I don't know. Could take a year, could take a couple of years. But, silver starting to move a couple of chunks of $10 up is, I think, very realistic. One other thing to maybe consider, and because we're in a rate cutting cycle, is that I came up with a chart about a year and a half ago where I looked at what happens to the silver price. When I saw what happened to the gold price in rate cutting cycles, I thought, let me apply this to silver and see what comes out. And so when you have the Fed cutting rates, typically gold will start to take off almost immediately. Silver reacting differently, partly because it's an industrial metal and there's always this concern of a recession and will demand fall back. I think that's what causes the lag. And we have the benefit of hindsight, and we can see that about halfway through these Fed rate cutting cycles, silver tends to bottom. So what's impressive is if you look at the average of the last 3 rate cutting cycles, silver gained 332%. If you assume, now the timing's a little bit off this time, I'll be honest and admit that in terms of where silver bottomed. Because silver, for me at least, in this cycle bottomed around the end of February last year, around $22. I believe that's where it was. We're now, I believe, at the midpoint of the Fed rate cutting cycle because they paused and now they've resumed. In any case, if you use the bottom from last February and you project upwards, that would take us to $95 silver. So, it's anybody's guess. Where is the end of that rate cutting cycle? Or at least where is the end of the run up in silver before a significant pullback or whatever?
Silver's global supply chain is showing signs of deep structural stress, and that's reshaping the market entirely. Massive flows of physical silver from London to New York have tightened global inventories, while lease rates and backwardation in futures indicate real shortages. The physical market, once dictated by paper trades, is now beginning to set the price. At the same time, industrial and investment demand continue to expand in ways unseen in decades. The transformation in solar technology, from PERC to the new TOPCon panels, has dramatically increased silver's role, requiring nearly 50% more silver per unit. Add to that the growing role of battery storage, now expected to reach 60% of 2023's solar installation levels by 2025, and silver's strategic importance becomes undeniable. With global industrial use now consuming nearly 2/3 of all available silver, every surge in investment demand compounds the pressure. Supply is flat, deficits are widening, and recognition of silver as a potential critical metal in the US could further amplify demand in the years ahead. Let's get back to the interview.
London is sort of the center for ETF silver storage, and that aside, because of arbitrage, because of concerns in the US that there would be tariffs on silver, a lot of silver had flowed out of London into New York. In fact, normally because silver is bulky, usually you ship it. If you're not in a rush, you ship it. But because of the arbitrage opportunity and because of the pressures, a lot of it was flown. So some of the dealers wanted it there very quickly. So a lot of this silver moved to New York. There was still demand for silver out of London, and that caused a squeeze. And we saw the silver price move up. We saw supply dry up dramatically. We saw things like in the futures markets, we saw what we call backwardation. In other words, the near-term price or physical silver was more expensive than the, longer-term silver contracts, which is not the normal contango state of things. So not typical. We saw lease rates go up to 39%. The day silver peaked at $54. All of these are big indicators of dislocations in the market. So there's no doubt that the physical market was very tight, and we're starting to see, and I think we're going to see this a lot more, and ultimately it's going to be the new way, but that it's the physical market that is now going to start determining the price as opposed to the futures market, the paper market determining the silver price. Solar installations in China could be slowing. I'm not sure about plateauing. Maybe at least the rate of growth is slowing, but there are some things to consider. First of all, you've got this, we've talked about this before, but you've got this new technology that's kind of taking over. These are acronyms, but the established one is PERC, was PERC. Now the new one is TOPCon. Already last year, I believe, 63% of new solar panels were being produced with this new technology. That requires 40 to 50% more silver per panel. The reason you would do that is because they're more efficient. It justifies the higher cost per panel. You're getting more energy output from that panel. So although the producers, the manufacturers of the panels, have been for decades thrifting and trying to reduce the amount of silver that goes into each panel, I believe that we're going to start to see that trend up. In other words, they will probably start consuming more silver per panel. It'll take some time for this to show up in the statistics, but I think that's what we're going to see. So that's an additional source of demand for silver from, even if demand stayed flat in solar panel production. Now you have this whole added layer of batteries. The cost of batteries and to store the power in batteries is falling and expected to fall by half over the next 10 years. We already expect for 2025 that we're going to see battery installations at 60% of 2023 solar panel installations. So that is really catching up very quickly. And I think the takeaway from battery and solar is that battery helps to make solar what I view as baseload power. Obviously, solar is there when you've got sun, and then the problem is nighttime. But if you can store the if you can store the power that you've produced from solar during the day and then draw on that at night, then you can have this constant baseload power, which you get from things like nuclear, for example, or natural gas, whatever it might be that utilities use, coal, whatever else. And so that just makes solar that much more attractive. Then you've got a few other layers to add to this. You've got the fact that technology companies, many most companies are looking to be greener. They're looking for sources of power that are considered carbon neutral, carbon free. Solar is considered one of those. And what we've seen is that you've got the large tech companies. Many of them quickly went to nuclear, but they were able to tap into underutilized nuclear capacity. And they have the billions or tens of billions it takes to, lock that up very quickly. And because it was untapped or dormant, you can kind of bring it back online more quickly. But if you're looking at new nuclear, you're looking at 15 years. Compare that to solar, you're looking at a year and a half to get a solar farm up and running. So it's a tenth the time that it takes. And we've seen uptake from tech companies in the US adopting different kinds of power. They're adopting they're adopting solar to the tune of 5 times faster right now over the past year or so. So you see that solar is certainly attractive to them. And you're not depending on a utility that's producing the power and to be connected to that utility. Many times you can actually have, if you've got the land to build out the solar farm, you can be completely off grid, so to speak. So you've got your farm, you're drawing the power from your solar farm, and you're not depending on someone to provide this power to you. So that's very appealing. I believe it helps to make them more confident, I would say, in terms of where silver prices are going to be. These are cycles, and mining executives are not, they can't escape some of the mindset that comes with. But I think that silver is now viewed as much more critical and crucial for industry. We see investment demand, of course, ebb and flow, but there's at least anecdotally some in the last couple of months, we've seen some tremendous stories about people flocking to bullion dealers and buying silver. But the mining executives now, I think they can be more confident of higher and sustained higher silver prices. So they'll be more willing to commit to exploration, to expansion, to acquisitions. And it's a small space. So I think that's important. The critical metal, critical mineral side of silver, I think, is absolutely a new dimension that has been added to the silver sector. In the US, they have a critical minerals list. As we speak, to my understanding, it's only on a list where silver is being considered along with other metals to end up potentially on their critical minerals list. So it's being reviewed and considered, partly because of the government shutdown that could take a little while longer to get a final answer on. So we don't know. Will that happen? Will it not happen? I think it's significant just that it's been added. This is the first time it's been added to be for consideration. What we have seen, one thing to keep in mind too, Ernest, is that 43% of all of the silver consumed in the US is imported. So nearly half of all the silver they consume, they have to bring in from other countries. So they're certainly not self-reliant when it comes to silver, far from it. And again, sort of an aspect of critical minerals and what we've seen happening. And it's interesting, how you've pointed out that the solar aspect of silver was a more sort of widely seen way that everyone was kind of on board. And it might have been more partisan in some ways. It was encouraged more by some administrations and so on. But this fact that silver may be considered more and more as a critical metal is something that I think all parties are going to be on side with. The world's becoming deglobalized. It's becoming more regional. And we've seen in the US, the administration has taken steps that we have not seen happen for a long time, where they've started to buy into companies. And, we've seen that a little bit on the tech side, but now we're seeing it on the mining side. They're taking meaningful positions in companies that have critical minerals, lithium, for example, copper, for example. They're starting to streamline permitting. They're making it easier for these projects to come on board and eventually get built out and produce. So we're seeing a lot of support politically for critical minerals and silver potentially in particular. So that absolutely is a new dimension. And I think that is just one more thing that makes sustained high silver prices just that much more likely. So silver supply is flat, demand is growing. Demand is at least 15% above supply. So 150 million ounces above. Solar takes 20% of all of the silver. Jewelry takes 20% of all of the silver. And investment demand is expected to take 20% of all of the silver. As I say, I think that investment demand, when we get the numbers for 2025, I think that will have been lowballed. I think that it's going to end up considerably higher. And interestingly, the Silver Institute does not include ETF silver in its calculations for demand. And their reasoning is that, well, this is silver that's held in an ETF. It's not consumed like industry or like jewelry. It could easily flow back. And my argument is, so is physical silver, investment silver, silver bars, silver coins, and yet those are included. And so I can't square that. But if you include the demand that's flowing to silver ETFs, then the market balance, in other words, the overall deficit, is going to be the third highest deficit in the last 10 years. So that changes the perspective. And that's why I think that it's one of the reasons I think that investment demand is being underestimated, underappreciated by the market. Another point to consider is that 10 years ago, industrial demand was about half of all silver demand. And if you add the rest together, most of which is some form of investment, jewelry, silverware, coins and bars, was about the other half. Now industrial demand is about 65%. So it's grown tremendously, gone to 2/3 from half. What does that mean? It leaves a lot less silver for investment demand, right? Because industry is not going to say, well, I don't need my silver all of a sudden. They need it. And what we've seen happen in the last few months, I think, has certainly been indicative of industrial consumers saying, I need my silver. It doesn't matter the price. So that, with investment demand layered on top, has led to, this pretty explosive run up. But to my previous point, if you've got industrial demand growing the way it has, squeezing out the portion available for investment demand, all that means is that when investment demand comes back in a big way, it's got less silver to buy, right? There's less silver available to meet that demand. And so what happens? Price reaction. It pushes silver price up. And I think we've started to see some of that happen now. I think we're going to see a lot more of that.
Silver's role in the new global economy is quickly transforming from a secondary metal to a strategic cornerstone of modern industry. The convergence of tight physical supply, surging industrial demand, and renewed investor attention is reshaping how markets view this metal. With the U.S. considering silver for its critical minerals list and global deficits deepening, the foundations are being laid for a structural revaluation. The message is clear. Silver is no longer just a store of value, it's an industrial lifeline. From advanced solar technology to large-scale battery storage and next-generation manufacturing, every innovation leans on silver's unique properties. As supply remains flat and demand broadens across both industry and investment, the coming years could mark one of the most significant turning points in its history. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.